Welcome aboard. I'm pleased that you've been able to join us today while we look at insurance and its importance to everyone in the construction industry. I'm Jim Doyle from Doyles Construction Lawyers and want to discuss today with you all the steps that one should take and must take to ensure that you have effective insurance at any stage. As an overview, we want to go into the relationship between the insurance contract and the construction contract. They're both serious documents. We've got to understand how they interact together. The other aspect is we need to look at the terms on which the insurance is obtained. Composite insurance, where it insures more than one beneficiary, has some difficulties in ensuring that it's effective for all beneficiaries. The other aspect that's important to every constructor is defining the scope of the insurance. You have the insurance clause, you have the exemptions, and you have the warranties and conditions, all of which control the cover you've got. The other aspect that must be looked at is the defining of the damage. That is, what amount of damage is covered by your insurance and how does that work? And importantly, we need to map out the effect that defects and defect consequences have on the insurance cover and the varieties of cover that one can obtain to cover against the risk of a defective item causing much substantial damages. So if we start off there with an examination on some figures that were recently released by the Master Builders Association for the risks in construction. And for contractors all risk, that's the insurance that's generally covering most of the risks that a contractor has during the operation of the construction activity. And we'll also look at public and product liability insurance and see the chances of coughing a claim in those environments. In contractors all risk, the MBA produced the figures that there's an 8% chance of suffering a loss and having to put in a claim on any typical contract. The average was $21,000, but the problem is that the average is a little bit deceptive. Some of the claims might be very substantial and some very small. So the idea of contractors all risk being a risky area is clear. If we look at public and product liability, then there's a 4% chance of suffering a loss, but if it involves personal injury, it's likely to cost you $128,000. So it's a significant liability, and the situation is you've got the cost and disruption while that claim is worked out. For property damage, it's smaller, but still there's the add-on cost of disruption to your construction and disruption to the staff that you've got working otherwise on doing a good job. And there's a 75% chance that the cause of those problems are defective product or workmanship. So that throws into strong contrast the idea that constructors and defective products are a great cause of concern and liability in that area. If we deal then with some fundamental concepts which it's important to understand in order that you've got an idea of why an insurer is acting the way he is and what sort of insurance you might be able to obtain and on what terms. First of all, I suppose, you start off with insurance. You need an insurer with some decent capital. So the issue is that without capital, life gets awfully hard if your insurance is with somebody like FAI, who went broke in some time ago, or any other insurer that doesn't have capital behind him. The other aspect about insurance is it's fundamentally a mechanism to share loss. So the idea is that you realise that in any project, There will be some projects which incur losses, and fundamentally the insurer expects that all the other projects will chip in with their premiums and return to the insurer a sum in total greater than the amount he has to pay out. So it's important that one understands that while one meets friendly, happy people in the premium obtaining department, when you come to the claims department, you meet a different type of individual who then has to be very careful about what claims he admits. It's important as well to see where modern insurance has developed from. Fundamentally, the insurance we have today in general insurance has developed from the Lloyds of London, which is a group of fairly substantial people who were prepared to underwrite shipping ventures, and they would, for the protection of the shipper, either of the cargo or the ship itself, and for the payment of a premium, they would stand behind the loss of the cargo or the ship. That basic origin of insurance carries through today, where there is a great duty on an insured to make a full disclosure that's relevant to the insurer's risk. You can understand that if an insurer is insuring a ship he'll never see, going on a voyage that he'll never take, and carrying cargoes that he knows little about, he needs a full and frank disclosure of the risk. The other aspect about Lloyd's is that fundamentally at the base of all this, the capital is obtained from names. That is, people who put their name forward to underwrite the risk if it occurs. And usually they operate through syndicates where they all chip in together to meet the losses that might occur. But they work obviously on the assumption that the premiums that are recovered will in any year be more than the losses which are sustained. That's an assumption that has worked very well for a large amount of the time since Lloyd started. But some 10 years ago, there was an unfortunate amount of claims, and the names had to dig deep into their personal resources to meet the risk. So the issue is then when you look at syndicates, you have a situation where they each take a percentage of the risk and they each moderate that risk by reinsurance. Inevitably, a risk that's written in Australia today will be reinsured in some other substantial company, Switzerland or London, where some part of that risk will be transferred to other people prepared to take some of the premium for some of the potential loss. The importance of the reinsurance is that it spreads the loss amongst the widest amount of people in the community, and therefore makes any loss that's sustained a small loss to any particular party. The other aspect is that you have to consider some basic concepts that arose when insurance was being developed and which are still important today. The one aspect is uncertainty. Fundamentally, you have to have a situation where it's uncertain whether the ship will arrive, whether the construction project will have defects. There's no certainty to it. If there was certainty to it, then the insured would be looking for a substantial win. So it's got to be an uncertainty. Therefore, there's no real interest in the insurer insuring wear and tear, because that's almost part of the course. That's going to be certain. The situation is that you don't insure something that's certainly going to happen. You only insure something where there's a risk of it happening, and that risk can be assessed by the information that's provided fundamentally by the insured. Additionally, you don't want any inherent vice in the things insured. So you don't want a situation where fundamentally the property that's insured, the ship that's insured, the construction project is designed to fail. You can't have a situation where the situation is that the insurer takes not a risk, but a certainty, because he can't calculate that. The other aspect that's important is the issue of moral hazard. Insurers are very concerned to insure an event where the insured person is motivated to cause the loss. So the circumstance is that one reason why defect insurance is hard to obtain is because the contractor, if he could insure all his defects and he got paid for the defective part that he had installed, he'd be motivated to adopt a very low standard of insurance in the future, of quality in the future. He wouldn't be worried about the defects. He wouldn't be worried about doing a good job, because he'd be able to recover it from the insurer. And where there's a moral hazard, insurers have grave reservations. And where they detect a moral hazard, if they suspect that somebody has torched his own building or caused his own loss, then they're very quick to deny indemnity and to fight to the last man. The other aspect is, particularly in older times, it wasn't meant to be a gamble. That is, insurance wasn't meant to be placed by people who were just interested in getting some money if a particular event happened. It had to be somebody with a proper interest in it. So there's many cases where if, for instance, you insure something and you haven't got a proper interest in it, then when your claim comes in, you don't get paid. So an example might be where a tenant insures a building, and when the building burns down, he doesn't get paid the whole amount. He only gets paid the loss he suffered, that is the burning down of his tenancy and the contents that he lost in that. So it's important that there's got to be some genuineness about the insured coming forward to simply seek indemnity in respect of matters which are uncertain and which he is honest and revealing of the risk involved. The other aspect is that you've got to look at some of the classifications in respect of insurance in order to understand what is being offered and what you can obtain for your premium. The first division is whether you're looking for first party or insurance of your own interest in something. So you might take out fire insurance on a building, and that's where the insurer says, well, we'll indemnify you. But you might take out third party or liability insurance, where you're asking the insurer to protect you from claims from other parties. So that's a basic division in the insurance contract. The other aspect is most insurance policies are written on an indemnification basis. That is, the insurer says, I will protect you against your loss, subject to the maximum sum insured. So the insurer says, well, you'll have to prove your loss, and when you prove it, then I will pay it. The alternative to that is a contingency insurance, where the insurer says, if your car is completely destroyed, I'll pay you $100,000. So the different types of insurance, one is your loss and one is an agreed figure that is paid on certain aspects. So that's important to know what you're dealing with there. The other important aspect is whether the insurance is joint or composite. That is, whether it's joint, that is you have insurance with another person and you're locked into that insurance as jointly people, as joint participants in that insurance policy. The contrast to that is a composite policy, where one policy insures a number of participants, each for their respective interest. And where that's important is if you have joint insurance and you've gone into joint insurance with a rascal, then the insurer will say the rascal's misdeeds vitiate the whole insurance for both of you. whereas with composite insurance, as we'll see, it's possible to arrange it so each person is independent of the other person and their skullduggery. The other aspect about insurance policies is whether it's an occurrence basis or a claims made basis. An occurrence basis says if your property burns down within the calendar year, then I'll pay. The claims made policy says if someone claims against you within the year, then I'll pay that claim whenever the matters giving rise to that claim occurred. They could have occurred 2 years ago. And that's an important distinction in terms of the policies that you're discussing. In the 1930s, PI insurance started to become popular for engineers and lawyers so that they might be getting claims from their clients and they are interested in getting some cover from insurers. Well, there they would have a claims made basis. That is, an engineer would say, whenever I receive the claim, as long as I tell you promptly about it, then you'll cover me for that claim. I've paid my premium for that year and the claim is made in that year, then I should get covered for it. Whether or not it might have been 20 years ago that a negligent design was done, or last year when the design was done, if it's claimed in this year, then it's paid in this year. The PI has a concept of a retroactive date. That is a date that the insurer will accept claims for. So you might have a PI insurance obtained today and the insurer will say, well, we'll cover any claim that arises out of affairs that occurred within the last 5 years. And therefore, if it occurred 6 years ago, you're not covered for it. So you've got to be careful as to what sort of retrospective date you've got and whether that covers your affairs. Oftentimes, an insurer will say no retroactive date. They'll cover it whenever it comes in. But it's an important concept, particularly for PI insurance. The other aspect about joint insurance is that if there is a claim, it can be paid to either of the beneficiaries. That's pretty okay in the normal course of events. But if you've fallen out with your other beneficiary and he collects the whole amount, you might have something to repent and be sorry about. So it's important, again, to make sure that you're controlling a joint insurance to ensure you get the right outcome. But a composite insurance, the insurer pays each of the insured for their loss. So that if one insured has suffered a loss of $500, then he'll be paid $500. Whereas in a joint insurance, if they both lost $2,000, one joint insurer might get paid the lot. It's important to make sure that if you've insured and you're getting a payout, that it doesn't go astray. Let's look now at the types of insurance in Australia that we're likely to come across, and we'll deal mainly with two of them, the public liability and the contractors or risk and PI policies. But the situation, you've got public liability and everybody has it and should have it because the idea of someone slipping over in Coles means that they'll sue Coles for the unsafe premises. If you invite somebody to your office and they trip over your step, then they're likely to say the step was unsafe. It's ruined my enjoyment in life, my two lower limbs, so therefore you can pay many thousands. So it's an important insurance to have in any activity that you're doing in a commercial way. Workers' comp insurance is fundamentally run by the government in lots of ways. There's appropriate procedures put in place for that. We don't need to talk about that today. But professional liability, that is for negligent advice, negligent design, that sort of run of activity is important. And it's important almost for people that don't traditionally do a lot of design or traditionally don't do a lot of advice, because you might sort of come across an opportunity where you given advice on the right element to install, the right size of beam to put in, or the right sort of approach to take to various financial activities, and you could find, even though it's not in your regular business, that you're exposed to a liability. And the concern is there that you've got insurance that will protect you if in fact the claim's made. Then you've got the contractors all risk, which is usually to be obtained by contractors to protect all of the various risks they have in their activities. And it's important to realise that that's non-standard. It's not necessarily the same from one insurer to another. It's not necessarily the same from one policy to another. And it's subject to negotiation and bartering over the premium versus the cover available. It's important that you take particular care in that aspect. Other insurance that's available is directors and officers insurance, so that the liability in respect of corporate affairs are covered, transport when you're moving things from one place to another, or that might be an add-on to your other policies, and fraud, so you can insure against your employee running off with lots of money or otherwise conducting their business in his own interest and not the interest of the company. And they can be substantial claims. Fraud and corruption has been with the construction industry since at least the Romans, and it will probably stay there because the projects are unique, the projects are hard to manage to an individual level, and the projects require a great amount of trust in the people that are doing the job. So the idea then that somebody can say, well, I've ordered concrete on this job, but I've sent it to my mate's job, is pretty real, and the situation can amount to a substantial amount of money. Again, if you're in a situation where one of your site managers is taking in rubbish and waste from other sites, and you're having to deal with them on your site, but you don't know and can't measure how much is coming in and where it's coming from, is another risk. So it's important that that is a risk that insurance is available for, and you must turn your mind to whether or not you need it. The other aspect you've got to deal with is that you've got to look at the insurance contract and the construction contract, because they both go together, and usually having an insurance contract in place before or at the same time that you start a construction contract is pretty standard. So it's important that insurance contract is a promise by the insurer to indemnify you for losses, and that depends on you going through the process of getting that insurance, having it in place, and having it formally in place with a cover note or a policy that's been issued and a certificate of currency on it. The other aspect is construction contract is parties that contract with each other to provide works and get paid for it on a wide range of terms and conditions, and you've got to look carefully at that as to what obligations it imposes. The construction company the construction contract usually obliges the contractor to accept all the risks that are in certain sort of categories, accepted risks, and he then has the risk under his contract, and he then must insure it, and then he must present certificate of currency. So seeing how they work together and making sure that you've got the variety of aspects covered is important. The other aspect is the insurance contract and the construction contract come from different sorts of mentalities. We've seen before where the insurance contract is a contract of uber fides, which is Latin for utmost good faith. So since about the 1780s, that's about 300 or so years ago, the courts have decided that this contract is and requires from parties utmost good faith. It comes in two particular sorts of areas. One is that there's a duty on the insured to disclose all relevant matters that affect the risk to the insurer, and that's a demanding obligation. will see that if you don't reveal at all, then the situations of policy won't cover you. So it's important that, say, if you fill in an application form for the insurance, you actually make sure that that's accurate and properly organised, revealing everything that you know or should know would be of relevant to the insurer. So that if you've included a couple of workmen on site, if you employed a couple of site supervisors, and unfortunately during their use they got into trouble for bank robbing and other sort of measures of fraud, then you might have to disclose that to your insurer. Because otherwise, if bad things happen, the insurer might take the point for not paying. The situation is the insurer has less but still important duties as a contractor of good faith. He has to balance the interests of the insured with his own interests. He doesn't have to be charitable, but he has to be fair. And the situation is that's an important obligation, although it doesn't have the enforceability in lots of ways and the tangible obligations that are placed on the insured in that circumstance. The other aspect is in construction contracts, the situation might be summarised as caveat emptor or buyer beware. That is, if you enter into a contract for construction, you know you've got to have your wits about you and you've got to make sure that the terms and conditions of the contract are sensible and allow you a fair chance of completing the works and getting paid for them. The other insurance contract features are that you must have a look at the insurance policy sometime and sit down and read it and understand the provisions that go into it and how they operate. So basically, you get a bit of an introduction at the top of the insurance policy. It tells you something about it. It also, you get a listing and a schedule of the amount insured, the description of the risk and other aspects. That's fine. Then you get the recitals, which go into more detail about the policy and what it's to cover. And then you get the insurance clause. The insurance clause is very important. If that doesn't cover your risk, you're going to be left short. So you should ensure that you've read and understand it and that it covers the risk you want to cover. The other aspect is you'll get the exclusions, where they say, well, we cover you for fire unless it occurs in summer, or we cover you for this unless you've provided you've got a full-time guard on the site. So those conditions and that insuring clause have to be looked at carefully to make sure you've got the scope that you want. The other aspect is that you'll have various other warranties, descriptions of risks and conditions, all of which should be looked at, as well as definitions. So it's a fairly complex contract in its own right, as probably complex as its construction contract. You've got to understand the structure that it's usually presented in and read that carefully to make sure that you've covered what you've got. And the circumstance is not only must you read the insurance policy you have, but you must be careful to read your other policies and to make sure there's no gaps in them. Take, for an example, a person who says, well, I'll have some public liability, that's fine, and the public liability excludes anything associated with defective design. That seems to be okay. You have your PI policy and you have you there, so it excludes it. Then you look at your PI policy and it says exclude anything relating to personal injury. And that's probably sensible. You're just giving advice and design. But when you put the two together and somebody slips over from a result of a defective design and puts in a personal injury claim, then there's a gap. So you've got to be careful that you looked at your scope, you checked your risk, and you checked all the what ifs that should test the aspect. The other aspect is, as inherent in this, is usually one will go through a broker. The brokers and his liabilities and duties are a complex subject in themselves, but it's important to understand that you should make sure that the broker's fully briefed on the risk and the characteristics of it, and that you have given him clear instructions as to the insurance that you want him to take out. I remember a case where I acted for a plastic film manufacturer, and he had very expensive machines and a very explosive set of plastics in his factory. It burnt down, the machines are ruined, he's got to start again from scratch, and the dispute comes because the broker has taken out an insurance policy but left off the loss of profits that might come. So the issue was whether or not there was an extra cover for the loss of profit. We had to go to court, and one day into the trial, the matter's settled with the broker and his insurer effectively paying out the claim. But it's important that you know what it is that the broker's instructed to get and that you check that he's got that amount. Otherwise, as in that case, it comes to being just a big blue that's caused everyone a fair amount of agony. Interpretation of an insurance policy is important, and there are myriad cases trying to set out the principles of interpretation and then try and apply them to particular policies. But the courts, in principle, are reasonably clear that the ordinary rules of the interpretation of contracts generally apply to insurance policies, that they must be read in their totality and commercially and sensibly. They should be avoiding consequences which appear to be capricious or unreasonable, so that if an interpretation doesn't look sensible, then perhaps it shouldn't be taken. And on the other hand, the courts will look at it carefully, and if they consider that the words are awkward, but the interpretation is in one direction or another, they'll usually pick it up. So it's important that it'll be interpreted, but it's very important that it should be clear. The other aspect is that outside the contract, there's limited recourse to other materials. So there's no point in saying, for instance, that in some circumstances that you had lots of chats or you've had lots of discussions or whatever, and that therefore the policy might mean this or that. It's better to have it written in the policy and to make sure your broker has insisted on the right words. The insurance contract is tied to the construction contract, say AS 4000 or any of that family or other families, will therefore make the contractor the insured, and he accepts the risk under the contract. He's therefore required to carry out to get his insurance. However, the principal still has a very great interest in the insurance and what happens if there's a problem, and he's concerned over the contractor's liability were a loss to occur. The scenario is that if you're dealing with a major international contractor, you might have a recourse to very substantial assets, but that can't be assumed in most cases today. And even those who have substantial assets have taken the appropriate precautions to insulate themselves from a life-threatening disaster. So the principal is motivated and usually determined to make sure that the contract is adhered to, and further that the insurance is obtained. And you'll see that where you're required to produce certificates of currency at various times along the track throughout the contract. The situation is that it's awkward as well because the principal, if an insurance event happens, doesn't want to find out that there's problems in the henhouse. That is, he doesn't want to find out that there's a restricted policy. So accordingly, and he's backed up by his lender, who wants to know that that policy is in place as well, because the lender is exposed if there's a cataclysmic event. So that aspect, which you'll be all familiar with, of checking and making and rechecking the insurance policies are appropriate and are in place, is endemic in the construction. Additionally, when we talk of insurance, we usually got head contractors as one step up the chain, and we usually have subcontractors. And again, one wants to check on the insurance the subcontractors has, because you've got a substantial exposure if that falls over. Looking again at composite insurance, where there's the interests of different parties, an example might be the owner and the lender might take out a policy. So they each have different interests. The owner is obviously interested in the capital aspect. The lender is interested in the amount he's got laid out on it. If you look at the situation, you'll see that there's a difficulty in everybody who has got an interest securing that interest. The situation is, if you start for the most light-hearted approach, you'll see that there's a noting of interest. So the lender could say, well, just note that I've got a bit of an interest in this. So that'd be helpful, but it doesn't really give you much hold on the money. If you provide that any loss, the loss payee must be paid to the lender, that gives the lender a bit more interest in the matter. However, that can change, and it might be the payment might go elsewhere. You could have an assignment of proceeds. That's a more secure interest, where you tell the insurer, if anything happens, I want to be paid as lender. But composite means separate and independent rights with the ability to protect that. So the lender and the principal might get together and say, we'll have composite insurance, and we can negotiate with the insurance that if, for instance, the policy wouldn't pay the owner because the owner is involved in selling illegal tobacco or something, then the situation is that wouldn't affect the lender. So one can negotiate with the insurer for composite insurance, where each has his own independent claim on the insurer, which can't be affected by the activities of other insureds. So it is important, because if you don't have composite insurance properly arranged and somebody does a non-disclosure, they don't disclose something about their risk, that could vitiate everybody's claim. Or they misrepresent something, they breach a warranty, they don't do what's required, or they show a lack of good faith in some aspects. So insurers should make sure that the insurance is arranged in a proper way. Again, with insurance, composite insurance, you'll see that's often taken out by a husband and wife who insure the home. And the concern is, and there's quite a few cases on where, one, there's a divorce, somebody ends up pretty uptight with it, and one or other partner tortures the home or tortures a restaurant. It'll obviously come down to the particular policy and the amount of involvement of one spouse and the other spouse's default, but it can leave one spouse out, and that is getting nothing paid. So it's important that you understand that principle and see where it's going. Defining the scope cover is important. We've touched on it, but it's important that you look at what you can get under a contractor's risk, and you look at what additions you can get, enhancements to that are available if you pay more premium. So the idea is you usually get fire, storm, lighting, malicious damage, theft, and stored remotely materials, and perhaps some limited cover while it's in transit. But you might extend that cover to cover personal injury, etc., and you might make sure the cover runs for your maintenance period to ensure that you've got cover for anything that happens during the whole period of the construction. The circumstance of the importance of the defining the scope is such that you have numerous examples of where the scope doesn't cover the event, that an exception applies and you miss out. The situation of whether you have cover extended to loss of profits, if you have them extended to a delay in start, or off-site storage of materials, is all something that should be discussed with the broker and made sure it fits into the policy. The importance of defining the scope is also that you need to look at other things that could occur which might not be covered. Cessation of works and abandonment, costs occurring in a gradual deterioration. So if something doesn't fail to give you a nice occurrence that the insurance can respond to, the problem is you might miss out. Again, if you've got filing foundations, retaining walls, and a situation where you've got specialist activity and with particular risks, it's a matter that you want to make sure is covered. And asbestos or contamination, you want to make sure that you're covered if you come across some of the circumstances of that, or you've looked at your construction contract and tried to leave that risk with someone else. So you've got to look through all the aspects, look at a risk analysis of the project and make sure you're covered. The other aspect is defining damage. You've got to realise that if you're on the principle of indemnity policies, you're going to have to work out your damage. One concern is that if you make a claim that is fraudulent, over-exaggerated, poorly based, then you might have the insurer denying any liability. Your duty of good faith is to submit honest claims, properly organised. So again, it's a matter of doing that and making sure that you can prove the actual loss you're getting. You're expected to be put back in the position that you were in before the peril occurred, but it's an aspect where it has to be looked at carefully. The situation is there was a case where there was a church insured for fire damage and insured for a reasonably good sum. Prior to the church burning down, the insured offered the church for sale to someone else. So they said, we'll sell this for $50,000 and we've got the insured for, say, $100,000. When the church fell into ruins due to fire, the insurer said, well, we're only indemnifying you, so we shouldn't have to pay you more than the $50,000 that you were prepared to sell it for. So you've got to look at the full causation of your damage and look at its extent carefully to make sure that your claim fits within acceptable principle and doesn't give rise to any concern that it's exaggerated or in bad faith. The other aspect about that's important for constructions is defect exclusions and how they work. Now, this chart here suggests there's a range, usually either 5 or 3 levels in the defect cover that you can get. The basic one is that it'll cover the defect and perhaps some of the other materials or property that was damaged. So if you have a defective reinforcement, then you might get the reinforcement covered, but you might not get much cover to consequential loss. And it's important that that's the lowest level of loss that you can cover, and often it's caught short because what the cost of replacing the defective part is perhaps 10% or less than the cost of the consequential damage. And if, for instance, if we use the example of a reinforcement, if the reinforcement is defective, but you've got to pull up the concrete to replace it, depending on your policy, you might not get paid for pulling up the concrete. So it's very important to make sure that you've got the right cover. At the top level of that is where the cover is given to fix the defect and all resulting damage. Now, obviously, you'll pay more for it, but you should know on what scale in this situation you're on. Do you think you're on the top scale when really you've only been covered for the low scale? You'll certainly find it out when you put in a claim. And the consequential loss that flows from defects is substantial. You might have a defect that, say, for instance, what you did was to cut through concrete, but instead of cutting through the reinforcement and therefore letting the concrete expand in a nice straight line. You didn't cut deep enough. The concrete cracks up and the insurer says, well, the whole thing's defective. I don't pay for defective parts, so I'm not paying for anything at all. You can get some fairly right-wing views from insurers, particularly when there's a substantial amount at stake. Looking at a few case studies now, this was a case study, Evolution Precast Systems and Chubb Insurance. And what happened here is that Evolution Precast were involved in a substantial piece of litigation out of the Opal Tower development. And the situation is that their policy fundamentally said, unless you're found sort of liable under your PI policy, then we don't have to pay your defence costs. That's all right, but the issue here was that the liability under the policy wouldn't be determined until we had a full trial, but along the way to a full trial, Evolution was spending a fortune in defending the matter. So the issue is, was Evolution entitled to be paid its defence costs as and when they were incurred, as it incurred them, or alternatively, only at the end if effectively it came within the right result. And the situation, the court said, according to that policy, Chubb didn't have to pay. You could see that if you're looking for defence costs, you ought to be very careful to make sure that you have got them to be paid progressively. Otherwise, the situation is that you can be very short of ready cash. The other one I want to mention was Power and Construction versus AIG Insurance Australia. And there, Barclays built a wharf in Darwin and it got damaged. They'd signed a release on some aspects and they'd spent another $13 million on fixing other defects. Carlin came in as an assignee from Barclays, so they took the job and presumably a liability from Barclays, and they had the opportunity of a claim against AIG, who'd taken over the liability from another insurer. And the question was whether the release covered the particular extra damage and whether or not the delay in pursuing the claim barred the claim, because claims generally have to be taken within 6 years of when they occur. And the court held that the release was effective, that is, they lost on that point, and also that they lost because they'd taken too long to bring the claim. And the court there suggested, and it's still a moot point, as to whether or not the 6 years is measured from the date the damage happens, so that if there's a damage, that the building fails on day one, does your 6 years start from there? Or does it start from the fact when the insurer denies the claim, and it might have taken you 12 months to put the claim in? So do you lose that year? The court in that case said, no, perhaps there's a situation where it should be from the time the insurer denies indemnity, but there isn't, that isn't beyond doubt. The takeaway from that is you claim early and often. You get a claim in as soon as you can, put any sort of semblance of a claim together, and you must take litigation if that isn't met, because without taking litigation, you're exposed to the concern that your claim won't be paid in full. There's another couple of cases I was keen to mention. One was a case where it was Allianz was the insurer and Delaware View apartment block was the insured. And the situation, the issue there was the apartment block they knew of a lot of defects that were surrounding them, none too bad, none structural, but they didn't declare it to the insurer. So they knew the place was in a poor condition, but they didn't disclose it. And then a typhoon came through, wrecked the place, And then the situation is the insurer said, we didn't tell us about this. So the circumstance is that that's a no-no, we're not going to pay. Now, the circumstance is that in that way, at that time, I think the insured got up, but you can see the issue. The issue is the insurer will take the point if the situation turns out in a claim where the claim is investigated in fine detail and compared to what the insured disclosed in its disclosure when it applied for the policy. The other case I wanted to mention shortly was a case of where people had said, we've had a defect claim. We think in one case, there was a contractor who claimed that he had poured concrete into a particular spot in a tunnel, and the concrete had gone into some expensive cables and effectively ruined them due to a defect in the cable structure. And the issue was that what was covered was the whole recovery of that covered, or was only a minor part of it. In that situation, I think 4 judges went one way and 1 judge went the other way. So you can see that it comes down to subtle distinctions at the time, and an important aspect to make sure that if you're doing high risk and high impact work, that you might want to negotiate for a higher range of cover under the insurance policy. The takeaways from this is you should carefully make sure that the construction of your policies are right and check them against the sort of scenarios that you might exchange. The aspect to defence costs is very important these days, because practically if somebody sues you for $1 million, you might spend a good third to a half of it defending it, especially if it's complex and it requires a lot of investigation and experts coming in and out and witnesses being required. So you want to look at that carefully. And the circumstance is making sure that your claim goes in early and that you're able to ascertain whether or not the insurer is going to pay. And if he isn't going to pay, you've got to get the matter to court pretty promptly. So that's sort of a pretty run through of the matters that I thought we should cover today, and that should sort of inspire you to read many insurance policies and take joy in discussions with the broker, and making sure that the risk that you're running inevitably in construction contracts is covered by a good insurer who's prepared to pay when he should. Thank you very much for attending, and I look forward to seeing you again.